In this month's Huntsville, Alabama real estate market update, we're going to cover what have prices done. Have prices gone up? Have they gone down year over year? We're also going to talk about bank failures, the safest places to put your money, and what is the Fed up to. But before we talk about that, make sure you hit the subscribe button to stay on top of all of the latest Huntsville, Alabama real estate news. All right, so let's jump right into it. So average sales prices have gone up in the Huntsville area 5% year over year from a $356,000 home. Now your average home in Huntsville is about $374,000. With that, the actual volume of homes being sold has gone down 21%, 574 homes this month down to 452. That has to do with the mortgage rate lockdown effect. A lot of sellers have that interest rate starting in the 2s or 3s and are simply not wanting to sell their home right now. And with higher interest rates, that is also locking out a lot of would-be first-time home buyers from purchasing their first home. So home sales are down 21%, but so is inventory as well. Inventory is starting to creep up. We're at 1,405 homes versus 511 last year. But if you look at the chart nationally, we're still well below historical averages. And so we're nowhere close to where we need to be to be considered a balanced or a healthy market. Most economists are predicting we're anywhere between about a 2 million to a 5.5 million home deficit. We were starting to decrease that deficit with new construction beginning to ramp up, but they have slowed down with interest rate hikes. And so the challenge is we're not building enough homes to create a dent in that 2 to 5.5 million home deficit. Best case scenario, if builders started to get ramped back up, we're looking at least 5 years, probably 10 years or longer before we can really make a significant dent in this housing shortage that we have and get to more of an equal balance between supply and demand. So with that, supply is up. We were still at historically low numbers about a month a year ago. We're up to 2.4 months, so we're headed in the right direction. The biggest challenge is, the typical supply, the normal supply balance is 4 to 6 months. So we're still well below that 4-month range at 2.4 months. And that's with demand being taken away with higher interest rates. And so the question is, once interest rates go back down, what's that do to demand? Likely that's going to make demand skyrocket again as more people can afford homes. And so since we're only at 2.4 months with the higher interest rates, we're still not in that balanced, healthy market we really need to be in. So we're in a seller's market, but potentially an extreme seller's market if interest rates start to come back down due to these bank failures that we've seen. So prices are up 5%. Interest rates have doubled over the last year. So what has that done to affordability? Before we jump into that, let's talk about what this affordability home index means. A score of 100 means the median income in our area can afford the median price home in our area. So a score of 100 is ideal. Anything north of 100 is a good thing. Unfortunately, for single family homes, we have dropped below that score of 100. We've actually dropped 22.8%, down from 123 to 95 for single family homes. For townhomes, we are north of 100, which is a good thing. We've dropped from 174 to 116. So expect to see probably more townhomes, more condos, more multifamily development over the next couple of years as we have affordability in that prices for more buyers to be able to afford these type of homes. So one of the things that's affecting affordability has been higher interest rates. And the Fed did recently announce that they are raising interest rates another quarter of a point, but it looks like there may be an end in sight. They are stating that there may only be one additional rate hike this year. And so the question is, how is that going to relate back to mortgage rates? Potentially in a good way, because a lot of the interest rate increases on the 30-year mortgage side has been pricing in this fear and unknown of what the Fed is going to do. So if they know that there's only going to be one more rate hike, you may see a little bit of easing in 30-year rates. Also, the 10-year Treasury bond has been down as of late as well. So that could cause 30-year rates to go down over the short term as well. So with all these rate increases, it's starting to create pressure on the banking system. And so what's happened is there's been a couple of banks that have collapsed, and there's fear that other banks could collapse as well. And the reason for that is as you open up a deposit account and they pay you interest of 1%, 2%, 3%, they've got to go out and you put your money to work to be able to pay you the interest rate. They loan out money to other people, or a common thing is buying treasury bonds, which is considered some of the safest investments on the planet. The challenge in this case was they were buying 10-year treasury bonds and the interest rates were increasing on that. So interest rates may have been 2% when they first bought them, and then as they were needing to pull that money out because people were doing cash calls and wanting to withdraw their money from the bank, when interest rates are 4%, how do you sell a bond from the government that's paying 2% when you can go down the street and get 4%? Well, you have to decrease the value of that bond and sell it at a loss, which is what created the risk in the banking system. And now there's risk of other banks suffering a similar fate as well. So that's what's going on in the banking system right now. The other thing that's potentially going to happen and may cause an even greater effect than interest rate hikes by the Fed is the tightening of these banks. So a lot of banks don't want to go under and have the same fate that these other banks had. And so the tightening of the credit market could actually cause greater effects towards a recession than even what the Fed is doing as well. With the Fed continuing to raise rates and banks beginning to fail, where is the safest place to put your money? Well, a lot of people say, banks are insured up to $250,000. Above that, your money may be at risk. Below that, it's still up to whether or not the FDIC has the money to bail that bank out and make good on that. And so a lot of people consider a small local bank not as safe as maybe a regional bank or a national bank in times like these. And so you've got small banks, regional banks, national banks. More likely a national bank might get bailed out than a small local bank. And so that's one thing to consider. On top of that, in terms of safeness of money, probably a treasury bill. The debt of this country is likely safer than the banks, is what a lot of people believe and consider, which makes sense. If the bank fails, are they more likely to pay off their debt or for the bank failure? Probably their debt first. And quite frankly, as we've seen in these bank failures, if they're not paying on their debt, then banks are likely to fail as well. So you've got the banks, you've got treasury bills, and then on top of that, probably the most safest place to put your money is hard assets. So that would be, crude oil. Nobody has a place to put crude oil in their home. So precious metals, gold and silver, and real estate. So real estate has up 5%. And the awesome thing about real estate is you do that on leverage. And so if you're putting 10% down on a home, it's not 5% appreciation. You're actually leveraged 10x. And so a 5% appreciation on a 10% down payment is actually a 50% return on investment on your money. So real estate is one of the safest places to put your money in times like this. So if you're looking to buy or sell during these times, send us an email at moving@mattcurtisrealestate.com. Again, moving@mattcurtisrealestate.com.